Howdy everybody, welcome back to Accounting 1101, where I'm very excited for today's video because one, in today's video I think we break a record. I have the exact same graphic in today's video 40 different times, and I think that's probably a record. I can't imagine any other video where they're using the exact same graphic 40 different times. So I'm excited for that. But also because today we learn all about how we come up with that cost of goods sold number. You remember back to your solid footing days, you would be given that number. You sold inventory. The cost of goods sold was whatever. And they just gave you that number. In the real world, we have to come up with that number. And that's what we're going to talk about today. We're going to talk about inventory cost flow. In other words, how do we come up with cost of goods sold and ending inventory? So let's get right to it. All right, so we're going to start off, and I want to tell you about my all-time favorite movie. Now, I grew up as an 80s kid, and as an 80s kid, I loved Back to the Future. So much that I've been kind of buying the different iterations as they came out on home video. I'm old enough now where I've lived through 4 different iterations of Back to the Future home video. The first one, of course, VHS, the old video cassette you'd put in your VCR. And then they upgraded to, the DVD set, and where they basically took one really great Back to the Future movie and paired it with just an okay Back to the Future movie and one that was crap. Of course, I'm talking about Back to the Future 1, 2, and 3. So I upgraded to that, and I had that for a long time. Blu-ray came around. I didn't upgrade to Blu-ray because I'm cheap. I didn't want to go out and buy another one. But then when the 4K version came out, I had to get to Best Buy. I had to get to Best Buy and get the 4K super high def. You can see, Doc's nose hairs in the 4K version here. So I had to pick that up at Best Buy. And so we're going to use that as our example today. The old Back to the Future 4K trilogy here on home video. Kind of use that to describe inventory at Best Buy. So just assume for the sake of argument that Best Buy sold me my one Back to the Future 4K pack here for $40. And that the cost of goods sold to Best Buy was $15. They sold it for $40. They paid $15 for it. Okay? So we know how to make that journal entry. We talked about that in Solid Footing. On April 30th, Best Buy sells one Back to the Future 4K pack to me for $40 in cash. Their cost of goods sold was $15. They would record a debit to cash and a credit to sales revenue. That records the sale. Then they would record a debit to cost of goods sold and a credit to inventory. That would record their expense. Remember, cost of goods sold is an expense, while also taking it out of inventory to show that they no longer have it because I took it home with me to watch at home. So we've talked about that. You know how that journal entry works. As I mentioned in the intro, the part we haven't talked about, where in the world do we get that cost of goods sold number of 15? You think, well, that's easy. It's what Best Buy paid for it. Well, yeah, but it's a little bit more complicated than that. So our video today, our goal, is for you to understand where that cost of goods sold number comes from. So let's go ahead and talk about that because it can get a little bit wonky here, a little bit complicated. Let's assume that Best Buy bought that pack a few different times during the year. We're going to assume that on January 15th, they bought 5 at a price of 12 for a total of $60. 5 times 12, $60. On February 15th, they bought 5 more. Only this time, the price went up a little bit. You know how prices are. Inflation, man. Prices going to go up. So Best Buy bought 5 more, but this time they had to pay 13 for a total of 65. The next month, they bought 5 more. Now they paid 14 for every one of them for a total of 70. Then finally, on April 15th, they bought their final shipment. They got 5 more, paid 16 apiece for them for a total of 80. So as of April 15th, they had 20 total Back to the Future trilogy 4K packs there. And they paid various prices for them. price went up every time. Their total amount they had paid for all those 20 was $275. Okay? So, our little example, the cost of goods sold was $15. But if we look, well, they paid different prices throughout the 4-month period. They're buying that inventory. So how do we know? How does Best Buy know exactly which one of those sold? They have 20. How do they know which one sold when I go in there and buy one? The answer is they don't really. They can't really identify if it was one that they bought on January 15th, one that they bought on March 15th, one they bought on April 15th. They don't know for sure. So what we do is we have to make an assumption. We have a cost flow assumption. It's impractical for most retailers. Think Walmart, Lowe's, Best Buy, Kroger, anybody that sells goods. It's impractical to determine the exact item that was sold. Here's my 20 different Back to the Futures. Maybe I bought that one right there that was purchased on March 15th. Who knows? We've got to make a cost flow assumption to account for the cost of goods sold. So, we have a few different cost flow assumptions that we can use in accounting. And a cost flow assumption, we're assuming, forget the old saying about what you know about assuming, we have to do it in this case here. We assume items are sold in a particular order, just for cost purposes, regardless of how they really move off the shelf as far as the physical units are concerned. Okay? So this could have been the first one they bought, the third one they bought, the 10th one, who knows? Don't know. We're making an assumption that items are sold in a particular order just for cost purposes. Here are the 4 assumptions we can make. FIFO, LIFO, average cost, and specific identification. And I'm going to walk you through what each one of those are and kind of use our Back to the Future example to describe them to you. So FIFO stands for first in, first out. We're assuming the first ones we bought were the first ones that sold. Okay, first in, first out. We're assuming the old units are sold first. Our ending inventory is going to consist of the newer units, the ones we bought more recently. So our cost of goods sold is going to be the older units. The ending inventory is going to be the newer units. First in, first ones we bought are the first ones out. FIFO. LIFO is the opposite. Last in, first out. We're assuming the new units that we just bought are the ones that are sold first. So our cost of goods sold is going to be the new units that we bought, not the older ones. The ending inventory is going to be the older units. So we have FIFO and LIFO. We also have average cost, where every time we buy something for inventory, we're creating a new average cost of inventory. And then we have specific identification. In that one, we actually can identify the exact thing that's sold. So Lowe's wouldn't do that. You think about like Lowe's has 50 hammers on the shelf at the store there. They don't know exactly which one sold. They just know a hammer sold. Maybe a certain brand model. But a car dealer that has 20 cars on their lot, they know exactly what car sold. It's a lot easier for them to track it because they have a small amount of really big dollar inventory. Maybe the same as a jewelry store. So specific ID, we only use that if we can ID every unit separately, like a car dealer, okay? And so then they can tie the actual cost of what was paid directly to the sale and record cost of goods sold that way. For the most part, we're using FIFO, LIFO, or the average cost. One of those 3 right there. And remember, the actual physical flow, what physical goods are leaving in one order might be different. That's okay. We're not worried about the actual physical flow here. Okay? We're just worried about assuming the cost and the cost flowing out. So let's do a couple examples here. Back to the Future trilogy here. We're using the FIFO method. You remember, I went in and bought my 4K video on April 30th. All right. If we're doing FIFO, that means that first in, first out, that would have come out of that first purchase that Best Buy made. Okay? So the cost of goods sold for Best Buy on that particular purchase would be $12. After that sale, they've only got 4 left in quantity from that first group. Total is now 48. So we add up the new totals there, 48, 65, 70, and 80. The ending inventory, let me get my calculator here, would be $263. Okay, now you might remember we had $275 in total inventory before that sale took place. Look what happened. Made a sale, $12 cost of goods sold, and the inventory is $263. Those two numbers add up, don't they? So the game we're playing here, regardless of whether we use FIFO or LIFO or average, is we're taking that total amount we paid for inventory and splitting it between what was sold and what's left over. Okay? Everybody kind of see how that works? A little FIFO going on there. Kick up the difficulty a little bit here. Let's say a customer comes in and buys 12 of them. Maybe I go in on April 30th and I love Back to the Future so much. I want you all to share in the love, and I buy a set to give away as rewards for doing such a great job in Accounting 1101. I would love to do that. My pockets aren't quite deep enough to do that. If you want to borrow mine, you can. But let's assume, for now, that I went in and bought 12. Okay, if we're doing FIFO. Again, first in are the first ones out. So we start at the top, January 15th. First ones in. Well, I sold 12. 5's not going to cover all of it, is it? Okay, we want to sell those 5. So $60 from those 5. Those are all now gone. I sold all 5 from February 15th. That's 65 more. Now I need 2 more. I sold 12. There's 5, 10. I'm taking 2 out of that group. So I'm only going to have 3 left right there. Okay, so 2 at 14 would be 28. Right on. We have 3 left over from the March 15th at 14. 3 times 14 would be 42. So that's how many we have left right there in that group. So we keep pulling from these different purchases until we get to the amount that was sold. 60 and 65, 125 plus 28. 125 and 28 gives me 153. My cost of goods sold on that transaction will be 153. My ending inventory would be 42 and 80. 122. And again, if you look at the total we began with, 275, split between what was sold and what's left over. FIFO. Easy as that. It sounds really complicated, but it's not. As long as we keep our purchases in order and keep a nice record, it's not that hard to do. First in, first out. Now again, I want to emphasize, the one that I picked up off the shelf, the 12 that I picked up off the shelf, the physical units could come from any of those purchases. We're making an assumption. We're assuming that the first ones that were bought were the first ones out the door, even though the physical units might not be. All right, so that's FIFO. What do you say we look at LIFO? Again, we'll take the idea that customer comes in and buys 1 video set here. LIFO, last in, first one's out. April 15th, last one's in. We bought 5 at 16. If someone buys 1 copy under LIFO, we'd have 4 left. 4 times 16, we'd have $64 left of inventory from that group. And our cost of goods sold for that one would be 16. Our ending inventory, again, what's left over from the other groups, 60, 65, 70. We can add those together. We get 259. Total inventory split between what was sold and what's left over. Let's go back to the example where the customer comes in and buys 12. How does that work under LIFO? Exact same idea that we saw in FIFO, only now we're going last in, first out. So again, we sold 12. So all 5 of these are going to go away. All 5 of those are going to go away. And we need 2 more from that February group, don't we? To get to 12. 5, 10, nothing left there, nothing left there. We'd have 3 left over there. We sold 2 at that $13 price that we paid, which would be 26. So you have 3 left over at 13, 39 left in that group. Okay? So 80, 70, and 26, 80 and 70 is 150 plus 26. Our cost of goods sold for that 12 would be $176. We have all of our beginning units on January 15th still in inventory. And we have 3 from our February 15th buy at 39. So 60 and 39, our ending inventory would be 99. Again, those two together, 275. What was sold, cost of goods sold, what's left over, what hasn't sold, ending inventory. FIFO and LIFO. Good times, right? This is one of those weird things that always sticks with you from accounting. Even if you don't remember how to do the problems and do the math and all that stuff, for some reason people always remember FIFO and LIFO. You can talk to someone that took an accounting class 10 years ago and say, hey, did you take accounting? And they'd probably be like, oh yeah, accounting. Debit and credit and FIFO and LIFO. I don't know why that is, but it just seems to be something that people remember. The final method I'm going to show you here, that average cost, every time we buy, we create a new average cost. And so January 15th, we bought 12 bucks a piece. 5 times 12 is 60. Then February 15th, we added to it. 5 times 13 is 65. So at that point, we spent a total of 125 bucks for 10 units. 125 divided by 10 is $12.50. So every time we make an inventory purchase, we create a new average cost of inventory. March 15th, we add 5 more. So now we have 15. Our total now is 195. 195 bucks divided by 5 gives me an average of 13. So every time we buy, we make a new average cost calculation. And then if we sell, we use whatever the latest average cost is. So on April 30th, we bought 1. At that time, average cost was $13.75. So cost of goods sold would be $13.75. Our ending inventory, there'd be 19 units left, wouldn't there? I sold 1, so we had 19 left. 19 at $13.75. 19 left times $13.75. So 19 times $13.75, $261.25. That would be our ending inventory. And you know where I'm going with it. You've seen me do it 10 times already. Total amount we paid for inventory being split between what was sold and what's left over. All right, now let's go finish up our example. We sold 12 under average cost. Our cost of goods sold would be 12 times $13.75. Our ending inventory would be 8 units. We had 20. We sold 12. We have 8 left over. times 1375. I'll let you all do the math on that one. Don't want to video it around too long here. All right, so comparing the methods here, FIFO, LIFO, and average, and you can kind of see LIFO leads to a little bit higher cost of goods sold in an inflationary environment where prices are rising, which is most of the time in reality. Prices are always going up. So LIFO is going to give us a higher cost of goods sold in that kind of environment, which is going to lower our net income. Higher expenses, lower net income. It also has the lowest amount for ending inventory because those are the oldest units. Those are the first ones we bought. FIFO is kind of the opposite. FIFO cost of goods sold in an inflationary environment is going to be lower, leading to higher net income because the ones we're putting in cost of goods sold are the first ones we bought. Inventory is going to consist of the newer items, so it's going to be a little bit higher. Average is going to split the difference between the two. You can kind of see the average cost method kind of in between the two as far as the numbers are concerned. So, to summarize, we started our Back to the Future journey here with $275 in inventory purchases. All we are doing is systematically separating that total amount into what sold, cost of goods sold, and what's left over, ending inventory. The reason I say systematically is because we're using a methodology here. We're using FIFO, LIFO, or average. We're using a system. In reality, corporations can really use all three. Not for the same group of inventory, but a corporation can use FIFO for some inventory, LIFO for some inventory, average cost for some inventory. And so there's a little bit of leeway there. One thing to kind of point out, though, internationally, if we're following international financial reporting standards, IFRS does not allow LIFO. Can't use it internationally. If you used LIFO in this country, GAAP, Generally Accepted Accounting Principles, allows that. But if you use LIFO for your financial statements, you also have to use LIFO for your tax returns, called the LIFO conformity standard, in case you wanted a nerdy accounting term there. So I encourage you maybe sometime, grab a financial statement, maybe Kroger, maybe Walmart, and dig into the notes to the financial statement and see what kind of inventory cost assumptions they're making. You'll see LIFO, you'll see FIFO, you'll see the average, you'll see all that stuff. And you can kind of really get a picture for how this stuff works in the real world. And not just theory. This is the way it's done in the real world. Probably with more computers instead of somebody scratching out stuff with a pen on a PowerPoint slide though. So now it's your time. I've got a couple practice problems in your homework for you. Go ahead and try to tackle those. If you have any questions or problems getting those done, feel free to reach out. I'd be happy to help you. And we are going to wrap up our chapter with inventory, and we'll continue on next week. We hope to see you back for that. Take care, everybody.